I genuinely believe that it is very possible that Bitcoin could hit $100,000.
We are experiencing a shortage in a commodity that the world can't live without. Demand keeps growing while supply is decreasing. Major mines were permanently shut down in Ireland and Australia, and shocks to the market could get extreme, which could send prices soaring. The world's fourth most in-demand metal is zinc. China's desperate for it. Learn more about how you can profit from this bull market at crushthestreet.com/zinc1. Again, that's crushthestreet.com/zinc1. Welcome in to crushthestreet.com. Well, we got on the line today Joshua Enomoto, our very own editor here at crushthestreet.com. It's a pleasure for me to interview him. His YouTube channel is Bullish Money. And man, this guy's an expert. He understands the general markets, gold and silver, and he's even now covering Bitcoin and cryptocurrencies. He's an expert across the board, and he even, in his latest article, mentioned the possibility of $100,000 Bitcoin, and we're going to touch on that here today. Lots to talk about, Josh. How you doing today?
Good. How's it going over there?
I'm doing well. You know what? I want to start off with the markets. One of your recent articles was market flashing red. And yes. You know what? Yesterday's headline in the news was NASDAQ posting biggest two-day slide since December as tech stocks are falling. And shares of Apple fell after a downgrade, with Amazon, Alphabet, which is Google, Netflix, and Facebook also declining. And many have said that the markets are dependent now on tech stocks. The US markets are just dependent on these few tech stocks. So just what are your general thoughts right now on the markets, and why are they flashing red?
Yeah, I'd like to specifically touch on the tech stocks that are experiencing some recent volatility. There's a couple of things that are going on, but primarily we have a consolidation problem, or should I say a lack of consolidation. You have all these tech companies, particularly semiconductor companies, that are pumping out different graphics processors and different chips and whatnot. And there's just so many of them. And when you look at the entire technology sector, not all of these companies are fundamentally sound. Now, it's great that individual semiconductor companies can produce an advanced graphics processor card. But in a year or 2 years or 3 years, that technology is going to be antiquated. What we're seeing with tech companies is that the price to forward new advancements in the sector, that price or that cost is going further and further down. That means that the big large conglomerates, the big large companies that are producing today's technology, they are fighting against time, because the minnows in the sector are able to really compete on a level that we have never seen before. And therefore, I believe that the volatility that we're seeing in tech is due to the fact that we can't support all of these companies, these major companies. There's going to have to be a lot of mergers and a lot of consolidations in order for the major firms to survive, because yes, I appreciate some of their products that they're pumping out, but again, tomorrow it's going to be antiquated, and it's just this constant battle to find margin where the margin is really sinking for everybody. And so I think you're going to see a lot of consolidations in the sector, and I think that's why investors are getting out of individual names, simply because their fundamentals are no longer sound. Now, the The big name, of course, that is experiencing volatility that everybody's paying attention to is Apple. And Apple is, for the longest time, has been considered sacrosanct in the consumer technology sector because of the iPhone and all their smart devices. They've really revolutionized the concept of portable smart devices. But what I think is occurring here is peak smartphone. Everybody talks about peak oil. Well, I think we're experiencing peak smartphone. And what I mean is that when you look at sales of smartphones in the United States, it clearly charts an S-curve, meaning that there's three phases in the S-curve. There's an infancy phase where you introduce a new technology. Then there is the expansion phase where everybody gets really, really excited about this new tech, and whoever is first to the market experiences tremendous revenues, tremendous growth and profitability. Then there is the maturity phase where that technology is now understood by everybody in the sector. There's more copycat competitors, and the differentiation among all the consumer tech products are very slight. And that's the maturity phase. The maturity phase is that everybody now knows about this exciting new technology, and everybody knows how to duplicate it. And the ability to generate growth, to generate profitability, is now a lot slimmer than it was during, of course, the infancy phase and during the expansion phase. So right now, Apple is facing a very serious crisis, whether they want to admit it or not. Now, does that mean that the stock is going to collapse altogether? No, I don't think so. And could the stock recover and post a profit for 2017? Yes, absolutely it can. But that doesn't take away from the fact that they have a very serious problem, because again, when you look at the chart for US smartphone sales, we are in an S-curve. We are definitely in the midst of the maturity phase. And in the maturity phase, it's extremely difficult for any company to survive because you have so many copycat competitors. I mean, go into a Best Buy store, look for yourself. Don't just take my word for it. Look for yourself. Look how many smartphones there are. Look how many smart devices there are. There are so many of them. There's tons of them in the fighter brand sector. There's tons of them in the mid-tier sector. There's tons of them in the upper-tier sector. I mean, up and down the supply chain of smart devices. There's so many, right? There's so many. And if Apple doesn't come out with something that is truly revolutionary and truly something that gets people to say, wow, I want that Apple. You know what? Apple does not have that privilege right now in the maturity phase of the S-curve. They had it certainly in the infancy and expansion phase, but they don't have it anymore in the maturity phase. It's like, I don't know if there's people in your audience base that watches NASCAR racing or IndyCar racing, but it's like when the yellow flag comes out and all the cars get bunched together to do the restart. That's kind of like what we're seeing in the maturity phase. You built up that Apple built up the big lead against the rest of the field, but now here comes the caution flag. We're in the maturity phase. Everybody gets bunched up. Now the restart happens. Now it's all chaotic. Everybody's struggling, and it's just a real mess. And Apple needs to find a way to distinguish itself, and I think that's going to be a big problem without, obviously, the iconic Steve Jobs.
Josh, so I completely agree with you. They've always had to continue to outdo themselves, and for the longest time they did. So let's talk about the market. How dependent is the market on these FANG stocks? Apple, for instance. And, what are your thoughts in general as to the valuations we're currently seeing in the Dow Jones, S&P, and U.S. equities?
Yeah, I don't want to sound like a doomsday person, but I think the tech stocks are the first big warning that the rest of the retail markets are receiving. Now, of course, whether you want to act upon that warning is completely up to you. However, you have to look at the demographics. You know, people always talk about the changing demographics in the United States, specifically that we're turning into a browner country. Well, we need to look at the demographics of the markets. That means that the market participation has typically been heavily centered towards the baby boomers and then towards Generation X. Now, the baby boomers are now definitely retiring, and they're exiting out of the markets year after year. And what's left are the younger generation. And as you know, the millennial generation is now comprises the biggest workforce demographic in the United States. And so the millennials really need to step up in terms of their participation in the markets. But article after article that you see from mainstream business media demonstrates that the millennials are not participating in the financial markets. And these are folks, these younger folks, have seen the market collapse, you know, perhaps during high school or during their college years, and they've seen firsthand how devastating that was to their parents or to their other family members, and they've received the downline devastation. And so at a young age, they ingrained in their minds that the market is volatile. The market can sting you and sting you badly. And you know, perhaps that is based on poor timing, you know, unfortunate timing. Nevertheless, you have a vast number of millennials who are leery of getting into the markets. And that's why you see a lack of participation. Since the 2008 market collapse, the participation level on average has not gotten back up to where it once used to be. We're seeing an actual decline in volume in participation per capita, and that's a major problem. The other problem that is connected with this is the fact that if millennials do participate in the stock market, they are more likely to participate in stocks that they themselves understand. And what do millennials understand? The FANG stocks. You know, I mean, millennials love their Facebook, they love their Netflix and their Google and all that stuff, right? They love the FANG stocks. They are more likely to invest in the FANG stocks, or more likely to invest in stocks that are similar in a similar sector to the FANG stocks. Well, if the FANG stocks and tech stocks and consumer technology stocks are tanking, guess who that's scaring? That's scaring the millennials, right? And the millennials are the generation that will support, that, or theoretically should support, the markets in the future. When they get older and when their income levels rise, they need to start saving for retirement. They need to put their money into the stock market. But if you see a crash in tech stocks, in consumer technology stocks, that's like a crash in the millennial index, if there was such a thing. And that's why people need to take this warning more seriously. It's not just an isolated collapse in one sector. Yes, it is. It is that technically. However, you have to understand that in context, the volatility is impacting this critical demographic of the millennials. If they leave, I don't know, because they are already not participating to the level that previous generations have participated in the market. So that is a big red flag. Obviously, you're not going to hear that on CNBC. You're going to hear it right here on crushthestreet.com. And I'm just telling you, this is, I mean, hopefully it's nothing, right? Hopefully it's just an isolated thing. But I don't know. This looks bad, especially when you consider the broader context. It looks bad.
Josh, I want to talk about Bitcoin here. Obviously, very hot. We've been covering it a lot here at Crush the Street. You've been covering it as well in your articles. Anybody can go back and click your name and see what you've been doing and what you've been saying. Bitcoin, last I checked, I think it was 26 something, 27, $2,800. I'm not sure. I haven't checked in the last couple hours, and that's saying a lot. I mean, we don't know where it goes. It moves up and down quickly. But the thing is Ethereum is catching up in a big way. If you look at its market cap, if Ethereum goes up another $100 and Bitcoin stays the same, it will successfully overtake Bitcoin's market cap. So I want to talk about Ethereum, and I also want to talk about Bitcoin. But before we get to Ethereum, let's start with Bitcoin. Cryptocurrencies that are at $114 billion market cap. And some are saying it's a bubble. But you think that Bitcoin is going to mop up the doubters, as you put in your latest post. And one of the things you said is that it could warrant a $100,000 price. So let's talk about that here.
Yeah, I understand that. First of all, I want to clarify. People will look at that $100,000 target and say, "Man, are you absolutely crazy?" No, I'm not crazy. I'm not saying that.
I've heard crazier predictions. So
yeah, I'm sure you have. And I'm not saying that. Just to clarify, I'm not saying it's going to happen tomorrow. I'm not saying it's going to happen by the end of this year. I'm looking at a very long-term target, but I genuinely believe that it is very possible that Bitcoin could hit $100,000, because first of all, you have to consider that there are paper equity stocks that also have the same price tag. You look at Berkshire Hathaway, and it's trading somewhere around $255,000 per share, and that's just the paper markets. So the concept of six-figure stocks or six-figure assets, it's not unheard of. And the main driver, I believe, for Bitcoin hitting $100,000 goes back to what I just discussed. There are a number of millennials that are not participating in the markets, and yes, they could be young and just having fun and not really caring about the future. But at some point, everybody starts to worry about the future and starts to put money, invest money for the future, for retirement purposes. And where would the millennials go? I mean, again, we're talking about the consumer tech volatility. And if we do see just a collapse again of consumer tech, that's really going to scare off millennials. You may not see millennial participation at all if such an occurrence happens. So where do they go? Well, millennials, being tech savvy as they are, they're definitely hearing about this cryptocurrency opportunity. And at some point, I believe that the information will start proliferating to the point where a vast majority of millennials will learn and understand the cryptocurrency opportunity. And when that happens, I believe you're going to see tons of money come back or come to the cryptocurrencies, because there's a lot of money out there that needs a home. And you know that there's a lot of money out there that needs a home because, again, since the 2008 market collapse, the volume, the participation in the traditional stock markets is way down. That means that there's money sitting on the table somewhere. And another interesting statistic I heard a couple of years ago was that if you took hold of all the 401k accounts and you total up their value, that value would equal the national debt at that time. And I think at that time, the national debt was somewhere around $16, $17 trillion. So there is, at any given moment in the market, there's trillions of dollars being traded, left and right. Well, if a little bit of that were to find its way into cryptocurrencies, that would just, you would see so much valuation spikes across the board. I believe Bitcoin would receive the majority of that speculation, but you're going to see up and down the cryptocurrency markets. You will see this tremendous enthusiasm. And once people understand Bitcoin, once people understand the blockchain technology that underlines these markets, I think it's truly a game changer, because when you look at Bitcoin, Bitcoin represents truly free markets. We as Americans always boast about having freedom and free markets, but it's not true. The markets are only open 6.5 hours, right? They're only open 6.5 hours on Eastern Standard Time. So when most people are waking up on the West Coast, it's like the markets have already started trading in New York, and by the time that it's past lunchtime in the West Coast, guess what? The markets have already closed. And once the market's closed, guess what? You cannot get back in. You can't, as a regular Joe Schmo retail investor, you can't participate in after hours trading. That's only for those with special credentials. Well, that's not free. That's not free markets. And you have to have, if you want to participate in options trading or other exotic financial vehicles, you have to get special certifications to do that. They don't just let you do what you want to do. So everything, when you think about it, is very controlled, and it's controlled based on human traditions. For example, the markets are open Monday through Friday, but they're not open on the weekends, and if there's a market holiday, they're not open on those either. Okay, or federal holidays or whatever, they're not open on those days. That means that human traditions dictate when trading can occur. That's not freedom. That's not free markets. Bitcoin, and on the other hand, it's open 24/7, 365. It doesn't give a crap about your traditions. It doesn't give a crap about your culture. It doesn't give a crap if you're trading Sunday at 3 a.m. It does not care. It is truly free markets. Anybody with internet access can participate. There's no respect for human mandated traditions and rules. It just trades based on the overall collective human psychology, and that's what I love about it. There's no such thing as Bitcoin being worth more in New York than it is in Zimbabwe. It's all the same. It's truly free. Everybody can participate. It is open. It is an open source network, and this is the revolution. We've never had this before, because in the paper equity markets, it was imbued with human traditions and human biases. There's a certain hegemony associated with the stock market, because participating on Wall Street is a lot different than participating in the stock market in Mexico, for example. Well, that's not the case anymore with the blockchain technology. That's absolutely not the case. It does not matter whether you have an American Bitcoin or a Mexican Bitcoin or a Chinese Bitcoin. Doesn't matter. It brings everybody together to participate in the financial markets, and that's the beauty of it. And that's also why the major elitist conglomerates desperately want to stop the cryptocurrency.
Wow. A lot of amazing insight there, Josh. I'd like to, when I first read the line you talking about mop up the doubters, or even just the words mop up, I was thinking about the altcoin quote unquote mess. and tons of them out there. I mean, coin market cap, I mean, we're almost at 1,000 different cryptos out there, and a huge bubble in many ways, because those who feel like they're missing out on Bitcoin and now Ethereum, they're just jumping into the next one, into the next one, into the next one. And no doubt there are certain ones out there that are worth our attention. But 1,000 of them, I don't know. There just seems like a lot of them out there. And I feel like whenever this corrects, even though I'm long-term bullish on this, the logical sense that I'm feeling is that the fear money, when the dust settles and we get a situation where things need to kind of get cleaned up, I feel like it's going to be Bitcoin that mops up the mess that is in the altcoin space. And I'd like to get your thoughts on that. And also, I'd like to get into Ethereum as well, but I'd like to talk about that altcoin mess and just get your thoughts on that real quick before we move on.
Yeah, real quickly, like you mentioned, there's just like so many of these altcoins. I receive questions about, hey, does, so-and-so coin, do you think that will do well? I'm like, literally, I have no idea, because it seems like they're creating these things, every single day. I mean, I just can't possibly keep track of every single one of them. My gut feeling is that we are heading towards a massive speculative rise, the expansion phase, if you will, of the cryptocurrencies. And so based on that wild speculation, I think a vast majority of the altcoins will do well. And I think we're nearing a point where you can just literally throw darts at, like if you go to coinmarketcap.com and you just start throwing darts and saying,
sure,
okay, I'm going to randomly pick these altcoins and we'll see what happens. I think, gut feeling, I think eventually there's a certain phase in the expansion cycle where, yeah, I think even random dart throwing will net you a very handsome profit. But you're right. I think once that, even within cryptocurrencies, there are great cryptocurrencies, good cryptocurrencies, and then there's the obvious crap. And that's the same with anything. You look at the stock market, same thing. You have your great stocks, blue chip stocks, and then you have your penny stocks. And a vast majority of the penny stocks don't do well after they experience their speculative burst, if they do well at all. So yeah, I think in the near term, when we go further into this speculative fever, there's going to be a lot of altcoins that are going to do very, very well. But eventually, the majority of those people who speculated in those are going to go towards the Bitcoin or the Ethereum that are very well established.
Okay, Josh, so let's get your thoughts on Ethereum. We have the Ethereum Alliance here. We got Microsoft, Intel, and just some of these massive companies that are getting involved in Ethereum. And on my last interview, I spoke with Luke Dodwell, and we brought this up, and I told him, I say, hey, it's kind of hard for me to imagine that these multi-billion-dollar corporations are going to get screwed getting into something that is a scam or that is destined to fail. So, but some people are very hesitant about Ethereum. They're worried about the infinite amount of coin or tokens, whatever you want to call it, ethers that could be created, and just the speculative bubble, because so many of the altcoins are based on Ethereum, and that's essentially what's pushing Ethereum up in many ways. So what are your thoughts on what we're seeing with Ethereum? You mentioned $500 Ethereum. We're not far from that at all.
Yeah, I wrote that back when I think it was at a time when it was $260 one day, and then literally the next day it jumped to $330, $340. So I said, yeah, $500. I think that's a very reasonable price range was about a 50% jump from the time that I was actually writing the piece. And, I thought that was a pretty good jump, but nevertheless a very reasonable jump from what we're seeing. Ethereum, I'm looking at it from a technical perspective. And I have to say that of all the markets that I've analyzed, Ethereum is a very strange animal. It is unique, I argue, from other cryptocurrency assets. It is unique from other publicly traded assets in that it has a stepwise valuation increase pattern. In other assets, you will see when you see a bullish rally, the asset will rise in market value, and then it'll collapse. It'll noticeably collapse, and then it'll go into a bearish cycle where the price continues to slide and slide and slide, and then until it starts building a support base somewhere. When the hemorrhaging finally stops, it'll start to build a support base. Maybe it'll go into a horizontal pattern, and then eventually it'll get back up to another bullish rally. We don't really see that kind of pattern in Ethereum. What we see is that there is a speculative burst of enthusiasm, and from there it will collapse, but a little bit, and then it'll largely go sideways for a very long time. Then it'll burst back up into the speculative rally, and then it'll go into another horizontal consolidation, then burst back up, and then yet another horizontal consolidation. We don't really see this dramatic bearish cycle. We just go into a horizontal consolidation, and I've never seen anything quite like this. But I think that nevertheless, you can still trust Ethereum in terms of its long-term potential, because these horizontal consolidations are very long. They're a lot lengthier than the time when Ethereum was in a rally phase. So when any market asset enters into a consolidation, there is a long negotiation between bulls and bears, and then finally at the culmination of this consolidation, there is either an upside move or a downside move. And so far in Ethereum, we are seeing a series of upside moves after these horizontal consolidation patterns. So I just look at the overall market, the overall cryptocurrency market. This is the future. I mean, whenever you're deciding whether to buy or to sell, obviously you have to take into consideration all the risk reward factors, but you also have to remember the broader context that cryptos are the future. The blockchain truly engages everyone. It facilitates a truly free market. And human societies are based on advancement and progress. They're not based on regression. Regression is what the elitist bankers want to do, because if the majority of investment money in the world went to the cryptos, that means that the elitist bankers have no cash flow. The bankers are the parasites in this equation. They're the middleman that always receives a fee, basically, from all the transactions that are occurring in the world. Well, that parasite activity, that middleman activity, is destroyed completely when you look at the cryptocurrencies, because the whole idea of the blockchain is to eliminate the middleman. So I would always look at that context, whether you're talking about Ethereum or some other cryptocurrency. I would look at the context of, this is the future. The blockchain technology is the future. And so when you're gambling on Ethereum or any other crypto, what you're really saying is that you're gambling that the sun will rise again, because that's where we're heading. I mean, we're not heading towards more regression. We're not heading towards more hegemonic control of our finances. We're heading towards open source. Everything is now starting to become digitalized, open source, truly free sectors for every sector. So that's the context that you need. And for me, I'm long both Bitcoin and Ethereum. I'm very confident. I think Ethereum $500 is a foregone conclusion. I think that $1,000 Ethereum is not too far from the horizon.
Well, man, there's been a lot of surprises, and many people are shocked. Now, Ethereum has done something that, I mean, is just absolutely epic. I mean, in January with single digits, just 3 months ago, it was like $18 an Ethereum, and in just the last few days here, it's gone up hundreds of dollars. And so, I mean, it's been pretty spectacular to say the least. So you brought up the bankers. I want to talk about gold and silver. Talk about a controlled, rigged market, poor gold and poor silver. Now, we get excited when gold moves $10, but we've gotten accustomed to Bitcoin moving hundreds of dollars. And it has to move $100 for us to even pay attention to it now. Right. Let's get your thoughts on where we are with gold and silver at the moment. I mean, silver, as we do this interview, was, in the $16 range while we record. And, we know that JP Morgan and these other bullion banks just have their grips on the markets. I read a headline, what was it, yesterday or a couple days ago? Nothing else matters. Central banks have bought a record $1.5 trillion in assets in 2017. So we know they're out there. We know they're controlling the markets. And I guess that's what's the beauty of digital currencies. We know they're not, and they can't control those markets. And we're witnessing what happens in a truly free market. But unfortunately, we're seeing the reverse of that in gold and silver. So any thoughts on that?
Yeah, I have a few actually encouraging thoughts. I noticed on the gold and silver charts that it looks like we're forming a long-term bullish pennant formation. This is a pattern where the markets are in consolidation, where the bulls and bears are in fierce negotiations, but these negotiations are increasingly in a tighter and tighter price range. It's like you're building all this pressure into an apex point, and at that apex, boom, something has to give. Either the markets start blowing higher to the moon, or it breaks down. Interestingly, I see this bullish pennant pattern not only in the gold and silver charts, but also in quite a few mining charts, the gold and silver miners, including the junior miners. So I personally am holding on to gold and silver investments, at least in the paper investments. The physical stuff I'm holding for the absolute long term, but the paper stuff, the miners specifically, I'm holding on to those because this pennant formation shows a lot of promise. I've seen the pennant formation, quote unquote, work in other assets that have demonstrated that pattern. So I'm just going to hold on. There's a lot of stuff going on in the markets, and coincidentally, we're seeing this pennant formation occur in the precious metals. So I'm just holding on. I think there might be some exciting developments in the near term. Now, I will say that there is somewhat of a risk when you look at gold and silver based on the cryptocurrencies, because everybody is so excited about cryptocurrencies, as they should be, that quite frankly we tend to forget now about gold and silver bullion. But I think that that may be a temporary risk. The longer term perspective is that a lot of the crypto investors are going to start saving their money not in fiat currencies, but in gold and silver bullion. I make this point because when you go, for example, to Costco, and when you go into Costco, there's a book section, and one of the best-selling books in Costco are those Thomas Guide street map books.
Wow.
Now, yeah, and people might think, really? People might think, are you crazy? How can Thomas Guide street map books be popular? How come they're selling so well when we're in the age of GPS technology and you can, with your smartphone, you can find out exactly where you are? Well, the reason why it's so popular is that businesses have a mitigation plan. What happens if you lose your smartphone, or you lose your smart device, or what happens if you forgot to charge it and you can't access it for whatever reason, or even worse, what happens if there's a rolling blackout, or we have an EMP strike, and all the electricity is down and the telecommunications are down. If something happens, what do you do? Well, a lot of people today, it's kind of scary, but a lot of people today will be like, I'm screwed. Without my smart device, without my iPhone, I'm screwed. Well, with these Thomas Guide books, you're not screwed. If you had the foresight to know what the address was, you can look it up. And that's why it's so important to always have a physical investment mindset. Yes, the cryptocurrencies are wonderful. They will net you tremendous, life-changing profitability, but you always have to secure something in the physical format. And it goes back to gold and silver. I mean, what happens if we do have this cataclysmic event where all the electricity and telecommunications are down? It doesn't matter if you made tens of millions of dollars in the cryptos. If you can't extract it from the internet, then you might as well have made nothing.
Sure.
And that's the importance of gold and silver. People recognize that. The astute investor, the astute business person recognizes that. So while they are making tremendous profits in the cryptos, the smart guys and gals are going to take a portion of their earnings, and they're going to invest in gold and silver, because that is about as surest of an investment that you can make. So that's why I'm still very much bullish. Doesn't matter. I mean, the Bitcoin could go to $10 million per Bitcoin, but if you cannot extract it, if you cannot extract physical value out of it, it might as well be worthless. And that's why gold and silver, they may be ignored now. Believe me, they will not be ignored for much longer.
Well, I agree with you, Josh. And I wish a lot more people, I guess I wish that a lot more people that understood the truth and understand what's going on with the economy experienced the gains that were had, or that were to be had, in cryptos. I feel like so many were in gold and silver, and the cryptos went right by so many people, and everyone's like, wait a minute, that's what gold and silver was supposed to do. I've been prepared for this mess, and I've been essentially punished for understanding the economy, and they're having to sit on the sidelines watching cryptos do what they do instead of gold and silver. Now, I do believe in the long-term bullishness for gold and silver, and I think these bullion banks are going to get caught running with their pants down. And I know that can't happen. They can't. You can't do that for very long before you fall over. And in that moment, I think there's going to be major short squeeze, and people holding the physical will be very happy. But with that, Josh, I want you to be able to share some closing thoughts and your general advice for people here as we go into the second half of 2017.
Yeah, well, I just wanted to say one thing about what you just mentioned. The elitist bankers, they can't plug all the holes. So in one way, yes, the gold and silver guys, I'm sure, are disappointed right now. But the elitist bankers will have to then go on to a misinformation campaign, as they are doing right now against the cryptos. Well, then that leaves gold and silver open for a tremendous profitability. And also, like I said, we're this bullish pennant formation that I just mentioned. This is a very, very long-term bullish pennant. I mean, sometimes you see bullish pennants occur over a few weeks, and the price pops up a little bit, and that's fine. But this formation has been developing for years. So for years, you're seeing this tremendous pressure, this tremendous negotiation be bottlenecked into an apex. I just think that with all the crap that's going on in the financial markets and also geopolitics wise, I think you're going to be very, very happy whether you're a crypto guy or a precious metals guy. You're going to be extremely happy. And the other point, the closing thought I would have is to just stay agile. You don't want to, whether it's gold or Bitcoin, you don't want to invest all of your money into one big thing. You never want to make this single-handed bet into one thing, because if that one thing doesn't pan out in the time frame that you had expected, it lends itself to incurring an opportunity cost. You won't always want to keep the powder keg dry. But with that said, my encouragement is to just be encouraged. Keep doing what you're doing. Don't let the markets get you down. Your time will come. It is a patient person's game. You can only lose by giving in and giving up. And I mean, I've experienced the ups and downs throughout life, and what I can tell you is that to reach the highs, it matters what you do when you're down. It matters what you do when you're down. You have to stay positive, and you have to commit to yourself that you're going to do whatever you can today to impact tomorrow. So that's my closing advice for all the listeners out there.
That's good stuff, Josh. I love that inspiration there too at the end. And actually, it reminded me of when you were talking about Bitcoin and gold and just kind of what we're dealing with, the manipulation. Andy Hoffman, he's written an article titled along the lines of, Bitcoin and gold, the twin destroyers of the fiat regime. And when you were talking about having to fight the banks, having to plug the different holes, this whole cryptocurrency situation is another huge hole that they're going to have to try to plug. And now it's like a two-front war with precious metals and now the cryptos, which is in many ways way out of their control. So exciting stuff on the horizon. Joshua Enomoto, contributor here at crushthestreet.com. Follow his work by visiting the site daily. Thanks so much for coming on the line, Josh.
Thank you so much.